This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here, host of the Smart Property Investment Show, a property investor. I've been a property investor for about 12 years, I guess you'd call it now. A successful property investor, you ask? Probably not. But I've done all right out of property, and one of the reasons or the catalysts of creating Smart Property Investment, initially a print magazine and then subsequent to that, this podcast was to actually give a sense for what it really is like investing in property. Have you been hearing me talk over the last little while? I've been sort of expressing some views around, you know, this dichotomy that we now have, which was when I started investing in property, information was a lot less scarce and you had to buy a property investment magazine to actually get the stories around it. Now you just open up your phone and go to social media or any of the podcast apps, and there's 1,000 property podcasts and there's 1,000 commentators in and around property. And I think that's a healthy thing because information can really help shape decision making. But one of the things that I do here at Momentum Media is a lot of work around misinformation, disinformation. This is how people are making decisions based on information which isn't factual. And that's whether it's deliberately not factual or it's just, which is disinformation, or misinformation is where someone just assumes something's fact and they just keep perpetrating those discussions around it. So you've got to be really careful with information that you are actually making your decisions based on what is actual real information. That harks back to why we started Smart Property Investment, because I remember I used to look at property investment magazines and all the stories were always perfect. And I'd go, that can't be the case. Like, I know a lot of people who are really blowing their dough in property investment. You only heard the great stories. You never heard the negative stories. And you need to remember most Australian property investors only own 2 properties. A lot of them only 1 property. And the reason why is they buy the wrong property first. So that's why we created Smart Property Investment and subsequent to that, the Smart Property Investment Show. But for those of you who've been tuning into this already, the mag, back when we used to do that, we used to have the little section called Investment in Action where we said, you know what, we'll do it ourselves. Smart Property Investment will create a portfolio so we can showcase how you go about doing it and warts and all, what we did good, what we did less good, what we got completely wrong and what we got really right. And it's been a very popular part of what we're doing. I've been a bit light on it recently, focusing on other things, but I really wanted to bring it back into the fore. The portfolio still exists, a little bit smaller than today than what it was back when we got to the peak with it. And I used to go through it with a very good and dear friend of mine, Steve Waters from the Right Property Group, who was integral in helping us set it up. He was one of the directors at Right Property Group, working in conjunction with another dear friend, Victor Kumar. So we're picking it back up. Unfortunately, Steve's not with us anymore, and a lot of you would have tuned into our podcast I did with Victor a couple of months ago, acknowledging the great work that he did in property investment. But Victor, we're going to get back into this, mate, and we're going to start talking about this portfolio again, because even today, I reckon there's more BS stories around property investment than what there was back when we started doing this. And the point is, this whole portfolio, the Smart Property Investment portfolio, now I own property in a number of different ways. One of them is through the Smart Property Investment Show, which is a shared portfolio I have with Alex Whitlock, one of the co-directors here at Momentum Media. We built this because we both went, let's actually show how it really works. And now a decade on, we can look at this portfolio and hopefully you can pick up where Steve, maybe if you built this portfolio, it would have been a better portfolio. and Steve would expect me to say that, no doubt, mate.
Absolutely. Yeah.
Steve would expect me to say that. But you're pretty familiar with this. You've been across it from the absolute get-go. And I remember really early days of property investor driving around areas of the western suburbs of Sydney looking at property with you.
Yeah, absolutely. And we did buy a few gems around that time. Yeah. But, you know, true to what you said, Phil, and this was our off-air rant as well, is that there's too much information flowing and there's no real check on the information. Whereas back on the days of print media, when you started SPI, the go-to was the back of the magazine where you showed the growth, and then you focused on investors and their stories. And it was actually good information, as opposed to everyone becoming a author, a journalist, and jumping on and giving their 2 cents worth, which at the moment is not necessarily fact-checked.
It's not necessarily fact-checked. And look, to all those people who are, I think most people that work in and around property investment, their intent is right. They all want to try and help people create wealth through property. And I think that's really good. The issue we have, though, is that I think a lot of people are framing their property investment decisions based on information which might not be complete.
No.
That's the point. And to dispel this idea of every single property investor in Australia can grow massive portfolios, that is fiction. It's not fact.
It is not fact.
It's not the reality for most people, and you need to be aware of that.
Yep. And there are a lot of sacrifices you need to make to build a big portfolio, right? Time is one thing. And then also the want and the drive to actually build that portfolio, because you're multiplying your problems tenfold.
You are.
And so if you think owning one or two properties is hard, owning more than that is much harder.
Yeah, and it's easy to hold a negatively geared portfolio when interest rates are low.
Yes.
And I think there's a lot of property investors right now going, wow.
Mm-hmm.
They go, well, it's this heightened rate environment. No, it's a pretty normal rate environment right now. So what we have right now is how you should be building your portfolio. But we built the Smart Property Investment portfolio for the purpose of it being largely a public resource that people could look at. And some of the headlines of this, and I haven't spoken about this portfolio for about 18 months, I would imagine, on air. I alluded to it last time we spoke about it. We've sold down, I think, 5 properties out of this portfolio. One of them on the Central Coast, one of them in St Mary's, one of them in Cambridge Park, which is a suburb of Penrith, one of them in Ambervale, which is a suburb of Campbelltown, and one of them in Mount Coringo, which is part of like the Hornsby thing. And the Mount Coringo one was the most expensive one we sold off. It's about 1.4 something million bucks we sold it for. And I think one of the cheaper ones would have been St Mary's, right? And we sold them about a year and a bit ago, over probably a course of a year. And I sit there now going, I wish I kept some of them.
That's right. And this is the thing with property investing, right? Once you liquidate the asset, the promise you need to make yourself is never to look back, right? Because they're in good areas. They will continue tracking up. But for those properties, they had done their job in the portfolio.
They certainly done their job. They'd all doubled, if not some of them more than doubled in a decade or so we held them. And so we sold off, Victor, about $4.3 million, $4.350 million bucks in property. Connected with that was about $2.3 million bucks in debt. So if you looked at that
just gross figures,
portfolio in isolation, $2 million bucks. So there would have been about 57% LVR or whatever. And that's sort of showcased the maturity of that, those properties at that point in time and growth. By selling those properties, we removed about $130K in negative cash flow.
Which is significant.
Which is a lot of money.
Yeah.
It's a lot of money. And that is, again, they were refinanced at a point not that long ago prior to selling them. So, there were a lot of them in negative position. I think particularly the Seaview Street one was financed. We sold that for 1.4. That was refinanced at 80%. Maybe a year or so prior to it. So it was significantly negative. I think in that alone it was probably about 60 grand or something, right? So it adds up. So that's the realisation of it. The portfolio that remains, Vic, for giving our listeners some stats around it all, it's worth about $6 million bucks, call it, 5.993 million. And that's a valuation, that's a Phil Tarrant valuation.
That's a Phil Tarrant valuation, so it's not embellished. It's fire sale valuation. And we were going through this sheet just before going on to air, and there's quite a few of them where I think you've at least got 50 to 100K on top of what you've put as valuations. Yes.
Okay. You would say that's a reasonable and a considered valuation.
Yeah.
So if we were to take this to sale, you would expect potentially in some of these areas maybe a little bit more.
A little bit more. Yeah. So your selling cost would be cushioned by the undervaluation that you've done.
Okay. And I would say we sold off the blue chip assets in this portfolio.
Yes, we did. Yeah, but it was again for a purpose, right? And we sold all of the Sydney properties that were getting more negative in cash flow. They were starting to demand a lot more maintenance given this cycle. But I look at it very differently in the sense that, okay, so you accumulated 138K worth of negative cash flow, 10-year period, you're walking away with $2 million. Yeah. That's 200K each year that you've made.
Yeah. But plus, and that's pre-tax, obviously. And obviously I have a very good accountant. Many people know Manzrul Khan, who does all this, and it's all done well. It's all sweet. So I'm happy with the decision. That money's been redeployed.
Yes.
It's creating wealth elsewhere. So no worries. I'm happy we did it.
Yep.
I sit back and go, that North St Mary's one with all the rail lines, like maybe we could. But we had great performance over a period of time, and I think we've spoken about this before. Those properties did their job.
It did. Yeah. And we bought them at a time when the market was flat and was just showing green shoots. So we loaded up in Sydney at the time.
Yeah.
And obviously, as time went by, it's certainly gone up in value significantly.
Yeah.
But then you're trying to consolidate that, like I said, to move the money elsewhere. And that is part of investing, right? So it doesn't matter if you've sold halfway through because it's done for a purpose.
Yeah. And a lot of them, to your point, and it's a very important point, maintenance was starting to pick up. They were starting to get pretty old, some of them really old. So you would have had to have knocked them down and developed on them. And I just didn't want to do that.
Yeah, you didn't have the bandwidth.
No, I'm just let someone else do that. That's fine. I'm sure someone will do that, right?
In fact, I did drive past the Yammervale one. There's a nice granny flat there now.
No.
There is.
Really?
Yes.
On the back corner there?
No, on the back corner, yeah.
See, we always thought we bought it for the purpose. Well, one of the reasons of buying it in this portfolio is they're good. They were good purchases at that point in time to deliver capital growth, but there was always some sort of
There's an X factor on it, yeah.
Yeah, and that continues with a lot of the portfolio properties that remain in the portfolio. So where do we sit today for the Smart Property Investment portfolio? $6 million in valuation. You think maybe a little bit north of that?
A little bit north,
yeah. The debts on the portfolio today, and I've got this big spreadsheet here, total debt is 3.315. So we're running at a 66% LVR, and that said, 4 of these got
so you pull the money back out of that.
They got refinanced about a year ago, so it's up to 80. So and they're probably some of the more expensive ones as well. So where does it sit today in negative cash flow? Sort of back of the envelope calculations. It's about $55,000 a year, give or take.
Before tax.
Yeah. To hold, which is now 1, 2, 3, 4, 5, 8, 9, 10, 11, 12, 13 properties. Is that right?
You need to buy one more, mate. You're in unlucky numbers.
Is it? No, hang on. Let me. Hang on. No, hang on. I didn't count that right. No. I think we could be. We've got. And for those of you on the watching this here, we've got. I think there's 12. 1, 2, 3,
12.
Yeah, 12 properties. Yep. And I'll tell you where they are. So there's 2 properties in Mount Druitt, which is a suburb of Sydney, Western Sydney.
And they're units.
They're units. So 2 of them there, 2 two-bedroom units. And we bought one of them for $190,000 back in September 11, and another one there for $179,000 in October 11. And if I look at those there, Victor, today valuation $395,000 for the first one, about $340,000 for the second one.
Yeah. Which is that
reasonable?
Reasonable, yes. It'll sell in a flash at that price. I think you short probably a couple of tens on that one.
And
but
to the point, that's sort of stuff, right, where migrants will move into.
That's right.
That's what that is, which is great. And
they were never pretty units to begin with, right? We made one of them pretty by doing a weekend renovation on one of them. And the beauty of this is, I think, from an SPI point of view, it dispels the myth that units don't perform.
Yeah.
And traditionally where the data was showing there was potential oversupply in that area, but it was the street that we bought in that made it really pertinent in the portfolio.
Yeah, I'm happy with that. So the first one there has grown by 107% and the other one by 90%. So they haven't grown as much as what houses do.
No. And this is a testimony to the houses have more immediate growth and far faster growth in the beginning. But eventually, well-located units do catch up. The numbers never look as sexy. But if you look at it from a percentage point of view, they do catch up eventually.
Yeah, they do. The first one there's got an LVR of about 73%, the other one about 69%. So they're okay.
Yeah.
Oh, no, sorry, I lie. 58% and 64%. Which ain't too bad. I'm happy with that. We haven't refinanced. Some of them we refinanced twice along the way, to be honest with you, right? We'll talk about that in a moment. Next property which is sitting there is in Logan, which is a working class suburb of Brisbane.
Yep.
Fair to call it that.
Largest LGA in Queensland.
Yeah, it is. So that was a townhouse that we bought for $145,000 in Feb of 2014. Today we've got a valuation of about $340,000. Okay.
Yeah, I think that's very low.
Okay.
If I look at my own Woodridge 2-bedroom unit, the valuation's at the early 4s.
Okay, that's pretty good. So 56% LVR on that. So we're holding about $192,000 of debt. So that's not really costing us a huge amount to hold. $400 a week in rent. That's delivering a yearly. Sorry, remiss of me. Those first 2 Mount Druitt properties. The first one about negative $7,000 a year. The other one about $3,000 a year in terms of negative income, negative cash flow on rents of $330 and $400. So you can see the difference, right? One's at $400, one's at $330.
That's right.
And that's purely just the cash flow position.
Just the cash flow.
Even though they're within walking distance of each other. The one up in Logan, $400, it's costing us $1,300 a year to hold that.
Which is not bad at all, right? And by the time you throw in your tax, even though that shouldn't be the reason to invest, it's there as a benefit at the moment, so you'd capitalize on that. And
that was refinanced recently as well. So, which was refinanced at 8%, has already come back a lot. They've grown a lot. I did the numbers on this recently. I was blown away how much this Queensland stuff had moved in such a short period of time. Then we have a property in Glenroy, which is a 2-bedroom, sort of more modern townhouse, I guess you'd call it.
Glenroy in Victoria.
Glenroy in Victoria. Bought for $270. Current valuation $720.
Yep.
It's crazy.
It's crazy, yeah. And this was relatively new, right, when we bought them.
Yeah, got a lot of depreciation stuff. It was April 14. We bought that. Currently giving us $590 a week in rent. Refinanced recently, so it hasn't grown a lot since we refinanced it. It's costing us about $11,000 a year to hold that.
Yeah. Victoria usually is...
Sorry, am I talking... No, hang on. I'm talking about Azalea.
Yep.
Oh, sorry, in Springfield there.
Springfield,
yeah. Sorry, that's...
Yeah, that's $11,000. That's what I was thinking. How did you jag $11,000 negative property in Victoria?
Yeah,
right?
No. That's so. Sorry, the Glenroy one is about $18,000 negative. The one in Springfield, which is a suburb of Brisbane. I think one of the largest manufactured suburbs in Australia.
It's the first master planned suburb in Australia. Yeah.
Is it? Okay. Yeah. So that was purchased for $270, current value $720. Yeah, that sounds better. And the one at Glenroy purchased for $322, currently valued about $628. Yeah, that makes sense. Okay, good. So it's costing $11,000 a year and $18,000 a year, and they've all been refinanced recently.
So with Glenroy, we bought this really well in the beginning because the bank valuation was a lot higher than what we'd purchased at the time.
That's right.
So we assured ourselves of growth, knowing that we're getting into a lot more negative cash flow property at that time. We assured ourselves growth, right? And if you look at the first half of the portfolio, bulk of them are units.
Yeah.
Right? Because that was the lending climate and that was the capital position and the vision at that time before we then changed tune and then started focusing on the lumpy growth houses.
Yeah. So what we're left with largely is in this portfolio now are units and or sort of strata type properties. I've never actually thought too much about that, but that's, when we get to the end of it here. So the next property is in Port Kembla, which is a suburb of Wollongong.
New South Wales.
New South Wales. One of the most beautiful beaches in Australia, they reckon. Yeah. One of the less beautiful downtowns Port Kembla's got a stigma. It's a steel town, right? But it's really gentrifying at the moment.
It is.
And I think this was probably one of the best buys in the portfolio. I remember when you guys put it in front of me, you went, Port Kembla, really? Yeah. But it's this property, there's nothing between it and the beach other than a big park, right? Like it's a good place. Bought for $320 back in December 14. Current valuation, really tough one to val. This one, Vic.
Yeah, because it's an unusual property.
But it's two townhouses on it that, which isn't strata, it's a single thing. Not the nice looking properties. They're built in 1955 or something or other, but this thing's grown quite a lot over the time that we've had it. Current LVR is sort of 80% or so because we only really recently refinanced it. But this thing costs about $17,000 a year to hold. Yeah,
and I think you are very light on evaluation there because standard houses there sell for $850 plus, especially something with water views.
Okay,
they absolutely sell for a premium. And house plus granny flats or dual income properties, they have $1 million tag on them.
Really? Okay, all right.
And this is the ugly duckling, right, which we can turn into a swan at any point in time.
Yeah, and we'll talk about what we're going to do with it. Then we have another property at Kingston, which is a house, classic sort of elevated house with a thing underneath it. Kingston, again, a suburb of Logan Way. This thing was quite problematic early on. We had like a whole bunch of
the issues with the roof
and now it's a really good tenant in there. Bought for $290, right? It's nuts. I got that currently valued at $620 Vic. It's 4-bedroom house. You're a bit light on that.
Yeah. I'd buy it off you at 620.
Would you?
Yeah.
Okay. Never refinanced, so that's got a positive cash position of about just over $1,000 bucks. LVR at 38%, right? Pretty good.
Yep. And this is a good example of testimony of time. And if you leave it alone, the LVRs drop right off. And so long as it's structurally sound, the rental just keeps rolling in.
Just keep going in, which it will do. So I think that in time, that's something I'm happy we've kept in the portfolio. It's had a lot of growth on it over the years. Built in 1980, so it's not that old, but it's old enough to also be a bit of hassle.
Yeah.
And then the last 5 properties in the portfolio is a unit block in Launton, which is a suburb of Moreton Bay in Brisbane, not far from the Sunshine Coast University. Is what it's called.
It is called Sunshine Coast.
Yeah. So I think on the train line it's Launton, then Petrie, and Petrie is right where the campus is, and then Kalanga. So it's in that little area there. Again, a good buy. We bought each of them for $190,000. I think it was $1 million, just
all up
for 5 properties. And I've got them. So they're sort of $200,000 a pop, valued in today at about $430,000 each.
Yeah, which again I believe is very conservative.
Yeah,
but the good thing about this portfolio is you're being ultra conservative with your numbers, so that there's no pie in the sky stuff to say, hey, look, I'm really equity rich over here.
Yeah, and I think that's what a lot of people do. They try and sort of paint this nice picture of their portfolio. I try and paint a real picture of the portfolio. And 3 of those properties of that 5 are positively geared at about $2,000 a year, and 2 of them are negative, less than $1,000. And the reason why is that I've moved the rents from in the mid 300s to 410 recently on all of them, but they've all got different cadence of when they renew. So once they come in, that'll be completely positively geared. And an LVR on that about sort of under 40%. So that'll just continue to grow over time.
It will. So one of the things with renewing leases in Queensland is we need to be mindful of the change in legislation there, right? So the rental increase is now actually tiered to the property, not the tenant.
Yeah.
So what I'm doing in my portfolio is I'm locking the tenants into 13-month leases as opposed to 12 months. Okay. So if they were to leave early, I can actually advertise it at market rates as opposed to having to advertise it at the same rate that the tenant left.
Yeah.
Right? And then I'm also, if I'm getting a tenant that's leaving well early and then the 12 months, I'm then doing, say, 15-month leases or a tiered lease where the first 3 months could be at the old rent.
Yeah.
And then I'm building in, because I'm now allowed to, after month 12, I'm building in the rental increase in the lease itself, right? So that when that tenant leaves, it's at market rent.
Yeah, and they've introduced those changes for reasons of trying to give tenants some continuity, around, which I'm okay with, right? The issue is, though, it's overcomplicated leases now. And someone goes, oh, they put my rent up after 3 months. You go, well, no, that's what the rent should be, but it's not market right now, so you're getting a small discount for a period of time, which a lot of people go, well, that's, again, they go, bad landlords, they jack my rent up after 3 months, right? Well, it's not really the case. So, you make one decision, it's got a consequences knock-on effect, right? Elsewhere, and whether or not it'll stay that way, who knows? So you can only put the rent up once a year for the property, irrespective of who's living inside of it.
So if you're doing 6-month leases and a tenant leaves after 6 months, you can't actually advertise it for higher. You have to advertise it at the same rent.
Which is okay. And rents have gone up a lot in Brisbane recently, and property values. And it was only a month or so ago I actually looked at this stuff and I was like, wow. And I put these numbers in, and to your point, you're probably a bit conservative on them, but I'm happy with where this portfolio is. Back to the point, most of these are units, or they're largely all units. So there's 2. Springfield is a house and land, Port Kembla is a house and land, and Kingston is a house and land. The rest are
just units.
The units, or a whole unit block which is controlled. So negative cash flow about 54, 55 grand a year, and that includes all the expenses, including
accounting fees and everything,
land tax.
So,
because all these sit inside a trust, so there's a lot of land tax. It's part of it. There's accounting fees. There's the accounting fees connected with the trust that's connected in with them. We price in all the asset returns around it, property maintenance, admin, maintenance itself, insurance, strata rates, council rates, water rates, management fees, and interest expenses. And of the $30 grand to an expense line of this portfolio, well over 200 grand of that is interest expenses. It's your most expensive thing.
That's right. Yeah, and I like the way you've gone absolutely granular with the expenses right down to ASIC fees, right?
Yeah.
So you're holding in a trust, so there'll be ASIC fees, which still on just a couple of $100, but they all add up.
They all add up, and you can see there where I've started pricing in the land
maintenance
tax
as well.
Yeah, land tax was inside of trusts in Queensland. I guess a point in time where once you tick over a certain amount, land tax is payable.
It is.
Whereas up until this point, it hasn't been on these things. So that's why a lot of people create a new trust, and that still exists, doesn't it?
It still does exist, yeah. Except in Victoria, where the land tax threshold has been decreased, right? So
which I'm now factoring in land tax on in Melbourne when traditionally we haven't had to do it.
Yeah.
So anyway, we factor most things in. There's bits and bobs missing here, but that's pretty much the Smart Property Investment portfolio today.
Yeah. So we started off with a vision, right, that this would obviously be a learning tool for the listeners of SPI. And we built a larger portfolio. Then we consolidated it. We've deployed the money elsewhere, as one would in terms of successful investing. But we've still kept the core properties that are very easy to pay down.
Yeah.
And it's a matter of now deciding, okay, do I leverage off this now, or do I, call it a day and then start paying this down?
Start paying it down. And you don't really, I'd be happy if this just moved to a neutral position.
Yeah.
And then just leave it there. What you'll do. And I'll just get my calculator out now. So if you got $6 million in valuation, compounding, at 5% a year, that's $300,000, right? So compound 1 year, 2 years. Oh, hang on, let's do this. I should really have a proper thing, but 6 million plus 5%, 1 year plus 5%, 2 years plus 5%, 3 years plus 5%, 4 years plus 5%, 5 years, $7.6 million. Yeah.
At a cost of circa $50K a year.
Yeah. So that's $1.65 million you get in capital increase over that period of time for pre-tax cash inclusion of $54,000. So 1.6, so we go 54, and that'll come down because interest rates are going up, interest rates are coming down, but 270 grand to manufacture $1.6 million.
Yeah, it's not a bad deal, is it?
That's how property works.
Yeah, exactly.
That's
exactly.
it.
Yeah. And we could now, if we come back to the individual properties, the houses we retain in the portfolio, right? Yeah. We could say, as an example, in Kingston, we could
let's have a chat about this, but we'll just go to a quick break. Stay with us. Back in a moment. Welcome back, Phil Tarrant. Having a chat with Victor Kumar, director at Ride Property Group, going through the Smart Property Investment portfolio. Now, Victor, it's worth $6 million is the total valuation, give or take a little bit either way. Now, people are going to say, "Oh, how much did it cost you to invest into it to get it started?" And we've spoken about this before. At a point in time, to start this portfolio, there was about 200 something grand went into it to buy the first few, and then was just refinancing over a period of time, capitalising on the growth to create a much larger portfolio, which we sold some off and now brought it down a little bit. That original 200 grand was pulled out years and years ago. So essentially, the portfolio, inverted commas, had no initial capital start.
It was on its own motion now. It was self-sustaining, And I look at it another way as well, Phil, is that, okay, we sold down some properties and we got circa $2 million out of it as a gross gain of the initial $200K that we've already pulled back out, right? So that on itself is a really good return in terms of your capital, in terms of growth. But we've also still retained a lot of the growth assets in the portfolio as well.
Yeah, and before the break, you spoke about some of those house and lands where there's probably quite a lot of upside for us. So that's in Springfield, Port Kembla, and Kingston. So Kingston, essentially, that in time you knock that down and build a house and a granny flat on it.
Yeah, you could. Yeah. Or you could give the main house a really good renovation. We did do some works to it initially, but bring it up to speed to today's standards and make it really attractive as an owner-occupier and put a ancillary dwelling at the back where it can be rented out separately.
And that would be for the purpose of both capital growth and also
cash flow.
Yeah. But where it's already positively geared, that property. despite the fact, and I think it's had by memory, some problems with had to insurance claims and all that sort of stuff, which is all good fun. But it's one of those things that sits in your portfolio. There's not too much. There's a good tenant in there.
Yep.
Not a lot to do. You just sort of set and forget, right?
That's right.
Hopefully get 5% growth on it. It's probably been growing faster than 5%.
It is, but again, it's the cycle at the moment, right? So the growth will flatten out at some point in time. We don't know when, obviously, but if you look at the standard Brisbane cycle from the bottom of the market to the next peak is 7 to 11 years, right?
Yeah, okay.
So at the time that we bought, it was pretty much no one was having any growth and the rent wasn't moving. But then it does that big catch up. And of course, COVID did help with this, and the lower interest rates did help with that. But that's the normal cyclical nature of it. And each state has got its own different cycles.
Yeah. And this is so to the point every property should have a purpose in your portfolio or something that you can leverage and get utility out of that. That's something we can do with that Kingston property. The property in Port Kembla probably has the most, I'm trying to think of my physics, perpetual energy. That's energy that you don't yet have. Kinetic energy is when it's moving. Yeah. So it's probably got the biggest upside if we wanted to realise it.
Correct.
Yeah.
And that could be what I would normally call a generational property, right? So you might not be doing the initial big upswing of development on it, but the next generation could.
Yeah.
And by the time the zoning may change even more in our favour to make it even more high density.
Yeah, and that's something that it's already got two, I guess, townhouses on it, if you want to call it that. I think down there zoning-wise, you're a lot more informed than I am. You could probably get 3 onto it.
Look, with good planning, so that council's very pro-development, right? So with good
What's
planning.
What's the council down there?
So it falls under Wollongong Council, or it may be just in the board of Shellharbour.
Shellharbour.
Yeah. So
I think it is actually Shellharbour.
Shellharbour, yeah. So depending on, so if you look in, and digressing a bit, if you're looking at development, you can get higher density by promising dwellings for the lower income. So you're taking a cut on the rent that you can provide. So it's a 20% decrease, but you can get more density on it. But that goes through a full DA process, and it does take time.
Yeah, or you go comply and development to be a bit more straightforward. But that is something where you could build 3 townhouses on it. They'd have to be adjoined.
Yes.
Strata them, sell off 2, keep 1.
Which would be a great exit strategy. Or you could say sell the lot, or depending on where the portfolio is at that time and depending on the appetite for negative cash flow, by building 3 and the depreciation that kicks in because you've built them, that would be self-sustaining.
Yeah. Again, you need a good accountant to help you with that, all those. So there's the strategy and the upside, but then what are the ramifications of that from a taxation point of view? And again, we've approached everything with this portfolio with a view to maximising that as much as possible within the requirements of the tax regime, and it sort of works pretty well. It works pretty well. So that has upside. And then you've also got this place in Springfield, which is, what's it costing us? About 11 grand a year or so. That's a relatively new build. I'd say it's probably early 90s by memory. Again, something that can just sit in a portfolio over time.
It could, yeah. And some often what you look at in a portfolio like this, it could be that the most obvious development is the one that you actually don't do because the house is just as robust at the moment and you just leave it alone. And with, say, Port Kembla now with the maintenance starting to creep up, you may bring forward the development on that, which has got the same, if not better, impact in the portfolio than just doing Springfield or Kingston.
Yeah, and I sort of think of development going, I don't want to be too hands-on. I can't be bothered. I don't really, it's too hard to drive down there. I don't want to do it and all that sort of stuff. Like how time-consuming is doing, like say, for example, we're going to put 3 townhouses on that.
Yep.
How much bandwidth would it require for me to do that?
Not a whole lot, right? If you look at it from a systemized approach, it's no different to buying a property because all you're really doing, the hardest bit is getting the design. So latching on to someone that actually understands that council and understands what they can get away with and maximizing it from a investment point of view without making the property illiquid. In other words, not working on so many dwellings on it that is not sellable, right? It's just good for rent, but it's not sellable in a slow market. So once you've solved that, it's just a matter of just getting the broker to get the finance and just tick off on the valuations every time it comes along.
Get a builder that doesn't go bust.
Yeah, absolutely. And which is one of the reasons why we're not pulling the trigger on these, right? So,
and it might not be the right time to be developing.
Yes.
You would argue. So it's nice to have that upside potential.
Correct.
For when we choose to use it, but will we deploy it? The other properties which are more traditional units, so those ones in Mount Druitt, and then you got 2 townhouses, one there in Logan in Queensland and Glenroy in Victoria. I think the Glenroy one, you'd be silly to get rid of that now. I think it's probably at its lowest it's going to be for some period of time.
Yeah. That market, particularly the unit in townhouse market, is very, very much at the bottom.
Yeah.
And if you understand the normal cycles in Victoria, it's from the bottom of the market to the next peak is 3 to 7 years.
Okay.
Right? So we could put a horizon on this to say, okay, let's come back and check in on this in 3 years' time to see how the market's performed. And if we've solved the negative cash flow via other properties in the portfolio, it could just be as simple as it's well located, it's in a high demand area. Over a period of time, it'll perform really well.
Yeah. Okay. So keep that there. North Road's probably the one property which really is nothing all that exciting about it. I don't want to sort of talk it down, but it's just there.
It's just there. Yeah. It was an opportunistic purchase at the time. We bought it well, but if there's anything that we would rationalize down the track, I suppose that could be one of them.
Yeah. And I've got a sort of valuation there at 340, debt on it at 192. So like if you sold it, you might pull 150 grand out of it, right? And you sit there and just go, is it worth it?
It's not worth it, right?
Just leave it.
Yeah.
It's not costing a lot of money, and in a year's time that should be positively geared.
Especially when the rates do come down as well.
Yeah. Yeah. So yeah, and that's another, you still look at interest rates, and there's certain people saying, well, the Reserve Bank should have really risen rates probably 2 more times after they stopped doing it. The Fed in the US is looking now sort of the cutting rates, but their rates are a lot higher than ours. So don't expect rate reductions any point soon. And I'm not banking on that, inside of this portfolio. You got the 2 Mount Druitt properties, and you're sort of holding 128 grand in equity in one of them, 123 in the other. So you sell them off, you'll realise $250,000 again. You've got to pay tax on that.
That's right.
Do you need to do it? You could refi, a lot of people are sitting there going, you got 250 grand of equity there, and you at 80%, you pull out a couple $100 grand, right?
Yeah.
It could deploy to continue to build the portfolio, but it's more debt. Do
That's
you need
right,
to do it?
So let's future pace this, right? And say you're an old frail man with your
sitting on a rocking chair,
right? And so we're now starting to think, okay, time's ticking. I'm getting into retirement. How do I rationalize the portfolio? So I'm starting to turn it into positive, because ultimately that's the holy grail, right? Is you want to get to the income. Growth has been phenomenal, but now we need to get to the income. You perhaps start, first of all, problem solving the negative cash flow. So looking at the properties we can build on to wash out a lot of the negative cash flow. And then
that requires capital as well.
It does, yes, yeah. And then the next thing we need to look at is, okay, the problematic properties that I don't want in retirement, or whichever way retirement looks to you. Maybe we time that with a good chat with Manzrul to say, okay, how can we plan this so that we are absorbing a lot of the tax issues that it'll bring from selling, but let's get rid of that. And then the next step would be to then get the most negative cash flow property out of the portfolio after all of that has been evened out.
Yeah, and some of them, they're only negative because they were refinanced recently. The point I would make, Vic, is that this portfolio is, call it a decade old, give or take, right? Some of the newer stuff was purchased in 2017, so that's that's 7 years ago, right?
Yep.
This idea of building a positively geared residential portfolio, right? This is still costing 50 grand a year, right? Some of that is because a lot of it all sits inside trust, so therefore there's
there's higher costs.
There's higher costs, right? There's all the accounting fees connected with it, but also land tax, right? A lot of this, if it was in personal names with a different, a husband and wife, for example, you'd be paying a lot less, right? So it wouldn't cost that much. But we're still talking about negative cash flow here, right? Rather than enough positive cash flow to replace your income.
Yeah.
This is a long way away from
It's a long way away.
It's a long, and that's 12 properties, right? So now I just want to dispel a myth, right? There's not a lot of people with residential property portfolios that are still building with debt against it That's replacing their income.
Yeah, because you need to get rid of the
we
debt.
spoke about this recently on Property Investing Insights, the Right Property Group podcast that we do.
Yes. So we need to get rid of the debt to get to it, right? So, and there's a methodology to it. First is, you're looking at restructuring your mortgages to begin with, right? Because you don't want to be paying the loyalty tax of staying with the bank and they're jacking up the rates as you age on their books. Then obviously we then need to look at, okay, how do we even out the negative cash flow? Do we pull the trigger, do smart developments, right? And get rid of the negative cash flow. Then you actually need to start paying this down. There's really 3 ways to pay it down, right? Surplus POIG income, surplus business income, or like you did, sell down some of this stuff.
Yeah, and imagine you could have easily if you use that $2 odd million to that you realise from the sale of it
to pay down this portfolio.
To pay down this portfolio, right? This is how much debt? Is $3.3 million of debt. So you got to put that in there. You'd be left with $1 million on
that's right.
$6 million. That's when that would instantly turn into a positive portfolio. And then so imagine if there's no debt on this would be providing you 300 and something grand a year in total income. Yeah. Less you're giving away 200 grand in interest. So that's can you live on a couple $100 grand a year? That's probably the ideal number for a lot of people, right? Which would grow over time.
It will. And one of the things that people don't take into account is they latch onto a figure. Let's say it was 100,000, right? But with everything paid off, your running cost is circa still 20%.
Yeah.
Right. So you need really to get to 100 net, you need to be 120 gross.
Yeah. Yeah. And these are, again, a frame of reference, putting things into perspective. They're the numbers that most people should be expecting.
Yes.
Property will deliver to them. Like there's probably only a handful of investors which are thinking, I'm going to be having a portfolio which is giving me hundreds and hundreds and hundreds and hundreds of $1,000s of that. Yes, it exists.
Yeah.
But that's not the norm.
Not the norm.
The norm is if you can get a positively geared portfolio, resi portfolio. I'm saying resi, and the thing to ask is what happens if you have commercial will change things. But that's okay.
Yeah, and it does take time, right? And this is where if you start with the end goal and are actually actively working on the portfolio, you can turn it into positive. But again, if you look at this is a decade's worth of work, and had we used the gross money from the sell down to pay this down, this would have turned positive straight away. Yeah,
it would have been. Yeah, it would have been putting good dough in your pocket. So let's have a little bit more of a chat about that. We'll just go to another break. Stay with us. Back in a moment. Welcome back, Phil Tarrant, chatting with Victor Kumar. Now, Victor, so this portfolio, I look at it and go, it's still negative 50 grand. And, you're that's pre-tax. So there's a whole bunch of stuff that happens in the background. And again, that's going to be different for every single person, right? Yep. How that looks. To be critical of this portfolio, a lot of people say, a lot of units in there, Phil. A lot of units don't grow much in value and this, that and the other. And we haven't spoken about that unit block in 5 units, which are all individual titled, but there's no strata.
Yep, because you own the lot.
Because you own the lot. I'd say that's a pretty good asset.
It is.
Yeah.
It is. Yeah.
It'd be hard to find those these days.
They are around. Yeah. They are around. Obviously not at these figures because obviously growth has happened, right? Now, if we bought the same block of units, say 5 years earlier, it would be cheaper still, right? So you need to really look at what the trajectory is and where it can end in terms of value, and of course, what cash flows attached to that value.
And this is a decade in for this portfolio, give or take. Say it's 2 more decades before. Let's hypothetically 2 more decades before I need to realise this.
You're ambitious. I thought you were 50 and almost gone.
Well, even let's say 1 decade, right? This is a decade and a bit. What will that $6 million be in a year's time?
Look, if you just look at past performance, right? So we've had the doubling effect in the 5 to 7 years. Now that doesn't always happen.
No.
So really, if you look at it from the next decade, I dare say that your 6 mil is likely to 10 or 12 mil if the trajectory continues the way it is, right? But there could be hiatuses along the way. And one of the things that I'd really want to flag is that 10 years goes by really fast.
Yeah, it does. And let's just assume you don't refinance this, anything in this. I can't see any reason why we would refinance this again. You would have $10 to $12 million in equity on $3.3 million in debt. So you'd walk away with $8+ million, right?
Absolutely would.
that's probably enough for, and that's 8 minutes. So you just maybe sell one of them, pay off the debt, keep it. You're going to be getting positive cash flow of in 10 years' time. Say now it's generating you about $300,000 a year now. You expect it to be $500,000 then
Easily.
Yeah.
But let's really downplay it, right? So let's say the rents did not move up at all.
Yeah.
Right. That's statistically not possible with the areas that we've got, but let's say it didn't. $300,000 in 10 years' time in terms of retirement income, that's pretty healthy.
That's okay. Yeah. And this is it, like start as soon as you can.
Yes.
Because it's just the compounding effect of property is, again, it's what I come back to when I go, look, managing this. It's not that hard. It's not easy to manage now. It's smaller, and I got rid of some of the stuff that was a headache. But what I would say, and you made reference to it very quickly, at some point in time, you've got to restructure debt. You've got to keep on top of it. And I went through a process of refinance this whole portfolio about 18 months ago, which was a headache, which was the right thing to do. We went from about, and because we sold down some stuff, maybe 5 or 6 lenders, major banks, a couple of second-tier banks, and I think a non-prime bank, and now there's only two in this portfolio.
Yeah.
There's 2 lenders, and had to work hard on the interest rates. Most of them are 6.49%.
Which is very sharp rates for today.
Or 6.5.
I think the highest one is 6.5 something.
So 6.59 and 6.49 is and hopefully that's the top of it. If that starts coming down into the 5s, you're going to be, if you're saving 1% on $220,000 of interest expenses every year, that's
significant.
$20,000, right?
Yeah, that's right.
$2,000.
$2,000.
$2,000, yeah.
Yeah. So if you look at it from a helicopter view, right? So we started this portfolio and we were buying in areas that were not fashionable at the time, right? And we're buying in the bread and butter area where we were really focusing on the liquidity in the market at the time, right? And then we were very early adopters in Queensland as well.
Yep.
And the opportunity.
I remember when you guys got me into Queensland.
You almost had a heart attack, right?
I was sitting there thinking, where's the growth, guys? I remember sitting there like chatting with Steve about it, going,
hasn't grown.
All that stuff you bought me in western suburbs of Sydney, it's gone crazy. What's going on?
Yeah.
I'm going, come on. And you're like, well, yeah, hang on.
It'll catch up.
But the point is that it wasn't the right time to invest in Sydney anymore.
Correct.
And you guys saw it as in deploy, and I imagine a lot of your clients maybe thinking the same thing.
Yeah.
Deploy your dough in here. Like, we probably got in there at maybe 18 months, 2 years before we necessarily need to. But I'm trying to think where else should have been investing at that point in time anyway, right? So, but then it's just gone, you know.
See, one of the things that most investors get caught up in is they've got really good result in one area and they stick to that area even though the fundamentals and the phase of the market has changed.
Yeah.
So really we need to be targeting, people say you can't time the cycles. I agree to a degree, but you can time the cycles by changing the types of properties you buy in those areas.
Agree. Yeah, that's a really good point. And this portfolio, by the way, is probably the best it's been in terms of administratively.
I was impressed with the spreadsheet, mate. It looks like a tablecloth over here.
I know, it does, right? But less lenders, so there's less
admin.
Less admin I need to balance with fighting over interest rates.
Yep.
And you fight over one, they'll normally apply it across your whole portfolio. Correct. I think with one of these banks, I'm a private client because of some of the other stuff I do. So I can speak to someone. They're really, really responsive and good. So that's cool. And if you look at towards the top of it, Vic, I sort of say, you see that point there, lease expiry, next increase, right? So I've got it set now. So, running across it, November 25, October 25, August 25, August 25, June 25. It's also all the decision making has been done. I don't need to worry about lease renewals now for probably about another 9 to 12 months for a lot of this stuff. So I've done all the hard work around it. So I can't really change the rents. And then you look at the rents. The rents are, I think, are pretty competitive now, having to go through that whole process of getting them done. So there's not a lot. I think the rents are where they probably should be. They're market rents. So there's not a lot to do with this thing now.
No, it's just that you've done the work and it's done in fits and bursts, right?
Yeah.
So one of the things I do in my portfolio, Phil, is when I get a lease renewal, right, I log on to Gmail. So I use Gmail as my email client and it has a send later function, right? So I program an email back to the property manager about 3 months before the lease is about to expire. So I'm starting that conversation. So I'm not letting life get in the way. I've used a little bit of technology. I'm then now forcing the property manager to come back to me, and it becomes front of mind.
Yeah, if you saw this, I've got traffic light systems around this. So like all that lease expiry, that would all be green.
Yep.
Then it'll move into orange, as in there's a change taking place, and it'll move into red, as in this is out of kilter now.
Yep.
So I just look at it and just go, tell me what I need to know. Okay, there, fix that up, move on. And I find the admin around property.
It's boring, isn't it?
Yeah, it's annoying. I hate sitting and talking to banks fighting over interest rates, which I know is just around the corner, right?
Yep.
You know, I don't think whether or not the lenders for this, and one of them is NAB, by the way, and shout out to NAB, they've been really good to work with. Are they going to pass on interest rate savings as fast as what they pass on the hikes?
Probably not.
No. So as an investor, you're gonna have to fight. Mm-hmm. You're gonna have to fight for sharper interest rates.
Yeah.
If the banks can get away with not passing on savings of interest rate cuts, you're gonna have to get on the phone. Mm-hmm. Or refinance.
Yeah.
So start thinking about being prepared
That's
to
right.
refinance. You don't. If your bank's going to pass on the savings and you're happy with the price points, and I think the mortgages I have right now are probably pretty reasonable for at a price. But just pass it on. That's all I want.
Yeah,
pass it on.
Right.
I don't want to have to fight.
Yeah.
I don't want to fight because that sucks.
But you've set the playing field well for yourself, right? So you've negotiated now before the rates are starting to come down, right?
Yeah.
So now your platform's lower, right? So when the rates do come in, they'll have to pass it on, and your platform's lower, so it'll come lower still, right? Whereas
I think so.
if it didn't negotiate and had a 7 in front of it, a 0.5 decrease there is not going to make a huge difference. Yeah.
And to your earlier sort of quip, as a client of yours, I used Fitting Mortgages to do all the refinancing. I think they would probably say the same as well.
Yeah.
They'd probably go, oh, God. Yeah. But you got to get your stuff sorted out. Let's just pretend, Victor, and I'll conclude with this. Just say I rocked up to Right Property Group and we sort of met for the first time and you went, oh, do you invest in property? I feel like, yeah, I've been investing for about 10 years or so. And you say, show me your portfolio. Mm-hmm. And if I showed you this, where would you critique it? Where would you say not knowing the history, just getting a prima facie of what you see right here, what would you say could be better?
Look, I would pull the trigger on the developments.
Okay.
Yeah, because then it's you getting rid of that 50K straight off the bat.
Okay.
And it is now neutral and it's not impacting
on the
lifestyle.
basis that I could finance the developments, right? Yeah. Yeah. Okay. And that is, again, it's perpetual energy. And it's going to make that choice at a point in time. But yeah, and it's good. Is this sort of reflective of a normal sort of portfolio?
Look, it is. And again, this is reflective of a decade-old portfolio, right?
Yeah,
in the beginning, it would look nothing like this. And I remember us talking in the beginning, we were trying to manufacture the equity because the market wasn't moving, right? So the types of properties we bought back then are very different to what we ended up with the block of 5.
Yeah, it's good. Well, thanks to you and your team for ongoing help with this, mate. We've got to do something. We'll do something in this portfolio, Victor, just so we can continue to tell the stories. But one of the myths I wanted to dispel is this idea that you know, if you hear and you're working with people saying, we're going to build a positive portfolio, go, yeah, that can be achieved, but it takes longer than a year or two. It takes time. Takes time. And this here, if we stopped and did nothing other than ensuring that the interest rates were the most competitive that we could possibly get at any point in time and the rents were at market, I would say this would be positively geared within 3 years.
Absolutely.
Yeah. And that might be the right thing to do, you know?
Yeah. Sometimes you don't want to tinker too much. If it's not broken, don't fix it.
No. And you know, sometimes that's the easiest way.
Yeah.
It's good. All right, Victor Kumar, thanks for your time, mate.
Welcome.
It's good to chat this through and, you know, you're very familiar with this. Maybe one time we can maybe knock down that apartment and you could probably build 4 times higher up there.
Yeah, absolutely would, yeah.
If you want to have a go at that. Thanks for tuning. If you like what we're doing, guys, remember to check out smartpropertyinvestment.com.au. We'll do more of this. I know a lot of people are really intrigued in this portfolio. There's a whole bunch of stuff we haven't covered. Might get Munjul and have a chat around it, around the tax and stuff, to give a sense to it all. There are a lot of moving parts to a portfolio. I will point out also all the loans in this are interest only. That was a big part of our refinancing. Vic was a mover from P&I, just didn't need to.
Just opens up the cash flow.
It does. There's obviously a lot of insurance connected with all this. There's still a number of different property managers. I'd like to tighten that up a little bit. Just, too many, in the clusters, you could probably group them up together, and we're sort of getting there with it. Probably not as responsive on as maintenance as what I should do. I probably could make that easy for property manager. Always go, why, what's happening? And they go, I told you this 4 times, and I go, well, I don't remember, So be nice to your property manager. It's the right thing to do.
Yeah, they've got a hard job.
They have a hard job. So this is just an example of the portfolio we built with the right property group. Now 12 was topped out about 17, I think, 18 properties. Still happy with it, and it still has a lot of currency. So we'll continue to tell the stories. There's lots of stories on this. You can check it out, smartpropertyinvestment.com.au. Remember, social media, if you like what we're doing, like us, follow us, all that sort of stuff. And please keep those reviews coming. Don't really ask for a lot at the Smart Property end, but if you like the conversations and this has been a podcast that's helped you make better decisions, please keep the reviews coming. More reviews is good. If you think we get 5 stars, that's cool as well. Some other things coming downstream as well. Watch this space. Some announcements coming up. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.